So welcome back everybody, and here in this Excel sheet you can see the key financials and the simplified financial model of our client, which is Industrial Holding Corporation. And here on the left hand you can see a simplified income statement. Here on the right hand side you can see a simplified balance sheet for the last 2 years. And here you can see the cash flow statement, which is the latest one. And basically, these are the three most important and key financial statements of any company. Obviously, in real life, especially if we are talking about huge industrial holding corporations like this, then they have way bigger and way more complex cash flows and balance sheet and income statements. But now we are on a training, and I think it's way better that you work with more simplified financial models in order for you to see the true meaning behind it. Before we getting really deeply into details, I have to highlight it again that it is normally the part of the credit analysis department within a bank, so it's not the sales responsibility to write the credit assessment. But as a relationship manager or as a salesperson within the financial institution, you have to be able to know the key components of the financial analysis, because sometimes you will have to actually defend your credit application or the client's financial performance. And how does defending the credit application and its financial figures in practice? For example, there is a credit analyst who's kind of rigorous person who says that the profitability of the client who is going to be the borrower is not good enough for the high loan amount they're applying for, and therefore he or she says that he's not supporting the transaction or supports, but with a remark that loan amounts must be higher and therefore the credit limit is going to be reduced. So this is a typical scenario, and you have to be prepared to say something against it, and especially when the credit assessment was too rigorous and the financials of the company in real life are way better. So going back to your example, on the other hand, you have to be able to show that even though the profitability, for example, was not that good, you have to show that normally, for example, any other financial numbers or the profitability numbers are very healthy and working properly and sustainably. So in such cases, you can say that, okay, the profitability is not that good, but let's say that the liquidity is going to be better, and therefore the downgrade from the credit risk part is not going to be that influential concerning your credit in the eyes of the decision makers of the bank. So you have to be always creative and always seek the best opportunities to support the client. I have said I'm going to walk you through at first through a simplified income statement. And here I'm going to actually define what means what. But at the beginning of this chapter, you had the reading task, and I hope you read them carefully, wherein the key parts of the income statement and the balance sheet are defined. But let's say here that in the first place, we have the net sales, which is $93 million, which is quite high. In this row, you always write the number, meaning that for example, how many of the key products or services of their client was sold within a year, and the cost of goods sold, in this case they are produced, then the production costs of the company linked to the selling of the key products or services of the company. And here, if you actually subtract them, you can get the gross margin. And if we go a little bit further, you can see that we have a small amortization compared to the company's size and activities. It's very small, especially if you see here that we have 180 million or 270 million balance sheet total for the company. So it's kind of very good. Um, we have some distribution administrative expenses. Expenses are always like, I don't know, marketing costs. So anything that is linked to the selling company's key products and services. And let's go a little bit further now. We have also an administrative expenses part. Here in this case, we're talking about, like, I don't know, the rental of the office for the corporation, or for example, the account keeping fee or the tax advisor's fee. And now the total operating expenses are added up by these two parts, the distribution and the administrative expenses. And we will get then the profit before tax, which is actually subtracting from the net sales the cost of goods sold. Then we get to the gross margin. Then we will subtract the depreciation, because it's also kind of a cost for the company. And then we will subtract the total operating expenses. From that, we subtract the 20% of the profit before tax. In this case, it's 20%. And we will get to $28 million net income for the company, which is quite good. In the next section, we'll analyze how good it is. And here in the 23rd row, you can see an EBITDA, which is 38 million. As you might have read it in the preparation part, this is the earnings before interest, depreciation, amortization, and taxes. And let's see now a little bit how it is actually computed. So here in this case, we have the net sales minus cost of goods sold, which is gross margin, and the total operating expense is subtracted from that. And then you can see that after that part, the corporate tax and the interest actually comes. So you can see that we get an EBITDA that is actually the result of the company before subtracting the mentioned four items. And EBITDA is also a key component of any financial analysis, because, for example, if you have to evaluate a company but it does not have stable cash flows, then you can say that the market value of the company, it's EBITDA. So it basically the produced amount of profit or money from the core activity of the company, and it is always a good proxy or metrics for the size and for the market valuation of the company if it is missing.